Alright guys, so the first concept we're going to learn is called the net present value concept, or the NPV. Now, in simplified terms, the NPV is the difference between the present value of your cash inflows and the present value of your cash outflows over a period of time. And the way this concept works is that it utilizes the discounted cash flow approach for the valuation of a specific project. Now, what does the NPV actually mean? What it means is that if you discount the cash flows of a project to today, you will get a number, and if that number is greater than 0, what it means is that the project adds value to the firm, and if the NPV is less than 0, it means that the firm has not utilized its resources appropriately and the project has actually been loss-making for the firm, or it's destroyed value for the firm. In more practical terms, the way the NPV is utilized by firms or corporates in order to make decisions is by ranking the projects based on their NPV. So what this means is if you've got 3 projects with an NPV of 100, 200, and 300, for example, and if all 3 projects involved a similar cash outlay or a similar capex on day 1, you should select the project which has the highest NPV. For the sake of example, assume we've got a project with this company where they invest $1,000 today, and let's call it year 0, which to basically build this plant, which gives them a steady stream of income starting in year 1 of $50, then $100 in year 2, so on and so forth, up to year 10, which is what we assume to be the total life of that plant. And at year 10 or after year 10, the plant effectively becomes defunct. So if we want to assess the merit of this investment or the merit of this project, how would we use the NPV to assess if this project makes sense or not? So before we go into the actual calculation, the first thing that we need is the discount rate or the cost of capital for this project, or which will be applied to the cash flows. The discount rate is a company-specific measure which tells you what the cost of capital for that specific firm is. At the moment, we're going to assume that the cost of capital for this firm is 8%. Now, Excel has an inbuilt Npv function which gives us the valuation of this project discounted to today. And that function is the Npv function. And the way the function works is we provide the discount rate and provide the stream of future cash flows. And what the function does is it automatically discounts this stream of cash flows to today. Now, if you remember from the definition that we covered in the previous video, the NPV is the difference between the present value of future cash inflows and the present value of the cash outflows, which in this case is this cash outflow of $1,000 in year 0. Now this gives us a present value of £302 rather. And so what this effectively means is that if we were to think of the value of this project in year 0 or as of today, then we would say that this project is worth $302. And in theory, we could go ahead and undertake this project because it does give us a positive net inflow, or it is value additive for the firm. Now, another way to look at this calculation, which is a more intuitive way, is that we calculate the present value of each of these cash flows individually to illustrate how the Npv function actually works in practice. So first thing is first, we calculate the discount factor Now, how do we calculate that? We calculate that by applying this discount rate to each of the future years, and we discount it based on the number of years which is provided here. I drag this out, and what it effectively tells me is that, as expected, as we move into the future, the discount factor which will be applied will be lower because $1 today is worth less in the future. Now, what we'll do next is that we will multiply each of these stream of cash flows with the discount factor. And this gives us the present value of each of these cash flows. And what we'll do next is we'll call this Npv Approach 2, and the way we will calculate this is simply by summing up this entire stream of cash flows, which should give us the same answer. And there we have it. So this approach effectively allows you to think about the NPV calculation, which Excel just does for us mechanically, but this calculation allows us to think about it in a more intuitive way.